of auditing deals with professional ethics. So basically, ethics are our moral values or our principles that guide decisions that we make. So business ethics are definitely necessary for corporate companies, as well as all different associations that govern people that work in business, just so that public confidence in the quality of the professions is there. We need to know that, especially when you're talking about accountants, that they are following the code of ethics and maintaining those higher levels of values. So then why do people do unethical actions? You listen to the news, where it's full of different examples. Do a little Google search of like accounting fraud, and you'll find tons of examples. So definitely happens. But basically, it's whatever they do is it differs from what we're expecting them to do or what we believe is ethical to do. So sometimes it's just selfishness, just people feeling like, hey, they work for a company and they think that company owes me, or vice president people who are just greedy and think, I can get away with this, like no one's going to catch me. And then it could just be that they're, the way people's personal ethical standards are different than society's. But I feel like most of the ones that I've seen are selfishness and greed. So ethical dilemmas in accounting, first in auditing, would be the threat of losing that client, and if they had to issue that unqualified or issue an unqualified opinion. So they're making a decision to say, okay, we uncovered something that might not be ethical, but if we disclose it, we can't give them that clean, unmodified report. Or if we confront them on it, we might lose that client. So that's a big thing. I mean, clients can be big money for these auditing companies. From an accounting standpoint, again, there's all kinds of ethical dilemmas. So people could steal from the company, but the one thing we think about with like following GAAP is that they could just overstate revenues or understate expenses, just fudge the numbers a little bit, just so the company looks profitable, so maybe the stock price goes up, or maybe if they're judged on net income, they might get a bigger bonus. So those are all kind of examples. So like in the work environment, you could have just scenarios where you think the boss is not treating people right. Maybe there's HR issues that are going on, or maybe they're like doing things like that you don't believe in with how they price their product, or are they trying to kind of like get around some environmental standards or things like that. I mean, there could be a variety of ethical dilemmas that you could personally face, but again, you got to weigh that with your job. So then some ways again to resolve it. One of the things is that, well, everybody does it, you know what I mean? So it's no big deal if I do it too. So that's a rationalization. And again, if it's not something ethical, it again depends on the level of materiality of that type of a rationalization. Obviously, you don't want to go to prison, because we're going to talk later about what types of consequences that could happen. So the process of resolution, though, is you're going to obtain the relevant facts, identify what that ethical issue is, determine who's all involved, who's going to be impacted, and then figure out, okay, well, what are my choices? Like if I, bring it, if I'm the auditor, I bring it to the client's attention, they could correct the situation, and, all could be well. If I bring it to my audit senior management or partner level, what could happen, and kind of understand those consequences from there, and then decide that appropriate action. So sometimes if you work in a company, I feel like the auditors are really just going to bring it to the client's attention, and they're going to not issue a qualified or a unmodified report. But if you work within that company, sometimes you might have the choice of either I'm going to quit, or I've got to blow the whistle on this company. I've got to call, like a lot of times there's a toll-free hotline, and you don't have to say who you are, but then you can tell what's going on in that company and, again, become a whistleblower. And there's different statutes that protect you from that. So accounting profession ethics, public confidence is required for CPAs and accountants. We want people to believe that we have the competence to do our jobs and that we are independent of the company that we're auditing or that we're representing. So independence is a big thing, though, for CPAs to remain unbiased and objective, especially if we're talking in auditing. So if they're doing an audit of a publicly traded company, they need to be unbiased and objective so they can exercise that professional skepticism, and they can really review it without feeling like there's anything, any personal motives on the line. And then what I have kind of italicized there is that it has to be in appearance as well as in fact. So because that public image is very important. So you want to not only know for sure that you're independent, but you don't want it to appear like you could be. So say, if your wife works at that company that you're auditing, so let's say she's just a cashier or something like that's not a key position, you would still want that all disclosed, and possibly the audit manager might even not pull you off of that audit. Now, let's say she's the vice president of operations, you most definitely, you're not independent. So, you really don't have independence. Competence, always with our auditing firms and our public accounting firms, that kind of ties back to being a CPA, like we talked about in the last chapter. They really want their employees to be certified and then to continue all those CPEs and have that knowledge so that they can be as competent as possible in their workplace. And what you have to understand with an audit, there's so many users of those financial statements. So you're just not talking about the responsibility you have to the clients. It's to anyone who's going to invest in that company, any bank that's going to loan them money. So that can really broaden kind of who they're responsible to. So we've got our code of professional conduct. We have principles, and the principles are responsibility, public interest, integrity, objectivity and independence, due care, the scope and nature of the services. So responsibility is just that we're exercising professional judgment. The public interest, again, is that we're maintaining that professionalism and that higher level of competence. Integrity is that, again, we're making good decisions, maintaining that public confidence. Independence and objectivities is that we're free from any conflicts of interest so that we have no personal motives that are kind of hung up in this audit. And then we exercise due care to help make sure the audit is done properly, but also improve our competence. And then the scope and the nature of the services is that audits you never want to take on a job that you don't have the skills to actually complete. So you want to make sure, again, it kind of goes back to that competence, but that you're accepting jobs that you have the ability and you feel confident that you can do. Then we have rules of conduct. So that's the enforceable part of the code. And we've got a conceptual framework where we identify threats, and then it gives you a list of some different types of threats. So adverse interest, advocacy, familiarity, management participation, self-interest, self-review, and then undue influence of the client. So a lot of these, as I read them, I feel like that all kind of goes back, a lot of them go back to independence. So you want to make sure that you're not participating in the management of this company that you're auditing, or that you don't have any self-interest in them. you shouldn't be reviewing your own work. It should go up to a higher level. The clients should not be able to put undue influence on any of the auditors. So those would all be threats if those things exist. Then if they do exist, though, then we move on to evaluate the significance of that threat. So is it just reasonable, acceptable? I mean, maybe there's always a little bit of undue influence from your clients. It's just kind of normal because you don't want to lose that job. You don't want to upset them. So that would be reasonable and acceptable. If it crosses over something that's no longer reasonable, then that would be a significant threat. Identify and apply safeguards. So again, if that threat is not at that reasonable level, then what could you do to implement these safeguards either at the client's level or at the auditing firm's level so that, you know what I mean, so it's not an issue. So if we would go back to say you have one of your auditors that are, have some sort of a self-interest. Again, they have their spouse is an employee there. A safeguard could be you pull them off that audit. They're not the ones who are going to be involved in it. So something like that. Then we have interpretation of the rules of the rules of conduct, and those are set by committee consensus. So they're going to, kind of consider the scenarios. Then we have the applicability of the rules of conduct. So independence, like I just said on a couple slides back, is super important to auditing. So it's only required, though, in those attestation services. If it's a non-audit service, then the CPA firm doesn't have to be independent. If it's the audit committee, they should be independent of the company's management, so not the CFO or the CEO. And then that audit committee is responsible to appoint the auditors, agree to the compensation of the auditors, and then the auditors report their findings directly to them. So it kind of, again, takes those higher level management people out of the process because, again, going back to that last slide, they can exercise like undue influence in certain circumstances. So we get into some of the different rules. Independence needs to be, again, in fact and appearance. So there's a whole list of examples here of what could violate the independence. So you cannot have a direct investment. You can't have a family member who has a direct investment. So maybe you don't, but your spouse does or your child does. If the auditor cannot work in a key position for 1 year after the audit work. So a lot of times auditors will leave the CPA firm and go work for that company. So they would need to be probably really not part of an audit, but they can't work in like, they couldn't be like, I guess, the CFO and then be a part of that audit. Only collateral loans, like, so say I guess you're auditing a bank or some sort of a finance institution. So say you have a loan with Huntington Bank and it's your home loan, you could still feel like your independence is not impaired. Like I already mentioned, close family members could not be key employees. They could work there, but they can't be like vice presidents, high level jobs. They cannot have a closely held investment with that company. They cannot serve on the board of directors, and obviously they can't be involved in an ongoing lawsuit. That would definitely not be independent. So Sarbanes-Oxley and the Securities Exchange Commission also has some different provisions. So they cannot perform, if it's a public audit client, they can't do bookkeeping, information services, appraisals, actuarial services, HR services, legal and investment services. So if it's a public company, all they can do is audit that public company. There might be some, like consulting that could be done, but none of these types of areas could be a part of that. Employment conflicts. so that again, this kind of goes back with that last slide. If an audit person's going to leave and become like the CFO of a company, there needs to be a year cooling off period. And then the partner rotation. So Sarbanes-Oxley forces lead partners to go 5 years on an engagement and 5 years off, because again, you get very close with the company's management and their executives, that then all of a sudden those close relationships could just be questionable. So it's better to have a rotation and have a new person come in who can double check everything, and then you can always cycle back. Then again, integrity and objectivity, we've talked about these two before. So you need to be free of any conflict of interest and keep an impartial attitude. And obviously there shall be no misrepresentation of facts, which is lying about any of the financial matters that you see. They need to maintain technical standards is another one, which takes us into our professional competence, our CPE credits. They need to exercise due professional care. The planning and the supervision of the audit should be, again, looked over and well maintained. So you want to make sure that you have the right individuals that have the history to and know the industry and know the economy and all that type of stuff related to the business. And then they want to, obviously, as during the audit, you want to gather sufficient and relevant evidence. There needs to be compliance with standards. So generally accepted accounting principles, standards, obviously, we need to comply with all of those. We need to keep our client records confidential. And the only time that the client's records could be released is if they're subpoenaed by court. So there's a lawsuit and they're asking for those records. If the audit firm is going under peer review, which we talked about in the previous chapter, so every year for publicly traded companies or every 3 years for private companies, then those people can look at the obviously the audit records. If we're responding to the AICPA ethics complaint, so again, normally those client records will be confidential unless there's extreme, these different circumstances. Contingent fees, so auditors can't and accountants really can't say, hey, I'll charge a certain fee, or like the clients can't say, hey, I'll give you a bonus if you give me an unmodified report, because then all of a sudden you've got some motivation to give that to them, so you're kind of not independent. You're hoping for a certain result. Or you couldn't say, like same with like a tax return, like the client can't say, I'll pay you more if you get me a bigger refund, because again, it's kind of not ethical. You should be following the rules and not be motivated by financial gain. Discreditable acts were also in these rules of conduct. So we can't retain the client's records if they've asked us to like move on. Say they're changing auditors and they want their prior records to be forwarded to their new auditor. Well, we can't hold those and say, no, we're not going to do that. Obviously, discrimination, negligence in the preparation of statements. So if we're doing anything that would be a violation of the rules and the trust that we have, and then failure to follow regulatory requirements or regulations. CPA firms can advertise, but they cannot guarantee results. Like they can't say, I'll get you a tax refund, or I'll insure you an unmodified audit report, because you don't know. You can't guarantee any of that, and it cannot be any type of false or misleading advertisements. Commissions are prohibited, so we can't work on on any type of a scale of commission. And a referral fee is possible, but it would have to be disclosed. So if you say, if they refer you and you get new clients or something like that from them, so you could do that, but it would have to be disclosed. The form of organization, I think we also talked about this in a prior chapter. They can't be a publicly traded corporation. So a CPA firm can be a proprietorship, a partnership, a professional corporation, a limited liability partnership, or a limited liability company. Cannot be like a for-profit corporation. Enforcements of all rules of conduct, actions by the AICPA. So minor violations that would get reported to the AICPA, they would say, okay, maybe you need to go through some sort of additional professional training so that you understand what you've done wrong. So maybe some CPE training. If it's a major issue, they could suspend or expel you from the AICPA. Again, if it's a major issue, the State Board of Accountancy could take away your CPA license. And then the PCA OB also has some different enforcement actions that they can do as well. Okay, so that is our ethics chapter.